Hello viewers, welcoming to you all to this educational channel Accounting Equation Academy. On the screen today topic is contract costing. So very important and interesting chapter in the cost accounting. Contract costing very useful to builders, civil engineering contractors for recording the transaction to ascertain ultimately the profit or loss made by a particular contract work. Standards are laid down which are to be followed by the contractors for recording the cost relating to contract and ascertainment of profit, value of work in progress, amount of profit transferred to profit and loss account in case of complete contract, and in case of incomplete contract and contract which larger duration for completion. The treatment of various items are suggested this method, and as per the cost accounting standard principle, the expenses relating to particular contract work are to be considerable for calculation of notional profit. The most of the expenditure are direct in nature, which are directly charges to contract. Besides overhead such as salaries of engineers, surveyors, storekeepers, etc. Such expenses may be distributed on several contracts on some suitable basis. Contract costing method is used when the work is generally of constructional and repairs nature. That is the construction of the building, construction of dam, roads, bridges. This method is used by builders, civil engineering contractors, constructional and mechanical engineering firms. Now here the meaning is contract costing is that form of a specific order costing which applies where the work is undertaken according to customer's requirement and each order is of long duration for completion. Contract costing, contract work, that is the building of construction of a building, construction of dam, construction of bridge, are normally of long duration. For a building, though the building construction depends on the size. So if the multi-stories building complex or 5 stories or 10 stories building is undertaken for construction by a contractor, so obviously this will not be finished in 1 year. So it will take more than 1 year. That is maybe 4 years, maybe 5 years. So that is why it is called long duration for complete. And the customer's requirements means the customers makes the design, the choice of the customer. The customer will determine the design, the structure, model of the building, and accordingly the contractor will build the house or contractor will construct the building or dams, road, and each order is of long duration for completion. So these are a big project. So big project usually takes long period of time. The work is generally of constructional and repairs nature. This covers various activities such as construction of dams, bridges, roads, ships, building, etc. So this method is useful for builders or who undertake constructional work. Now the types of contract. The types of contracts is basically contract price of work which is determined through negotiation between contractor and contracting. What will be the price of the contract work that contractor would charge from the contractee? Generally it depends on the nature of work. The type of contract is basically based on the price of the contract. Generally there are 3 types of contract. The first method is here, fixed price contract. Under this contract, price of a work is fixed, which is determined in advance or before work start by negotiating both the parties, that is contractor and contracting. The price is paid in installment depending upon the progress of work. Under fixed price contract, the contractor will charge the fixed price so that on the completion of that work, the amount is, say for construction of a particular building, is fixed rupees 5 lakh, and after the completion of the contract's work or during the progress of the construction work, the contractee, the total amount payable by the contractee is rupees 5 lakh. So this is the fixed price. The prices is determined, prices is fixed in advance. So later on the no prices will be changed. The price which is charged by a contractor from the contractee is fixed, and this is determined in advance. For starting the contract work, the contractor and contractee mutually fix the price of that particular work, and after the completion of the work, then the contractor will pay that fixed price to the contractor. The contractor pay to the contractor depending on the progress of the work, and it may be in installment, but the total amount payable is fixed. Second types of contract is fixed price contract with an escalation or de-escalation clause. Under this, the contract price of a work is fixed, but it may be changed subject to under certain circumstances. Sometimes owing to fluctuation in the price of materials and labor cost, the contract price is altered so that neither party suffer the loss arising out of change in price level. To protect these interests against the rise in prices, the contractor insert a clause as the escalation clause, under which the contractor will be obliged to pay the enhanced price of the contract because of increase in the rate of materials, labor and other expenses. Similarly, to protect the interest of the contractee against the fall in the rate of material, labor cost and overhead, a de-escalation clause is inserted. Therefore, under this method, price may or may not be remained fixed. If the price of material, labor cost, overhead do not change, then the price of contract work will be remain fixed. However, on change of price of materials, labor cost and overhead by a certain percentage leads to increase in contract price, also with certain percent. Similarly, if the price of material used for construction of works, labor cost and other expenses decrease by certain percentage, then contract price will also be changed correspondingly. Hence, neither party will suffer loss under the fixed price contract with an escalation or de-escalation clause. So escalation means the increase in the price or increase in the contract price, and the de-escalation is clause means decrease in the contract price due to the fluctuation in the materials cost, labor cost and other expenses. Then the contract price will also be changed. The third method is a cost plus contract. Under this method, cost plus contract is a contract in which the value of the contract is ascertained by adding a fixed and mutually pre-decided amount of profit or a certain percentage of profit over the total cost of the work. It is generally adopted in those cases where the work is spread over a large period of time and the prices of materials, labor, etc. are liable to fluctuate. Under this method, the contract price is determined after the completion of contract work. And under this method, both the contractor and contractee agree at a certain percentage of profit which is to be payable to the contractor by the contractee, and which is the contract price. Say for example, say for the profit margin is mutually fixed at 20% of cost, and say total cost incurred by a contractor for the construction of the work is rupees 1 lakh, then the contract price will be 1,20,000. That is, the total cost is rupees 1 lakh and plus 20% of rupees 1,20,000. So 1,20,000 amount is payable to the contractor by the contractee on the completion of the contract work, or the contract price is rupees 1,20,000. So here the meaning of the contract. Different types of contract have been covered under this video class, useful for constructional and repairs work, and different types of contract like fixed price contract and a fixed price contract with an escalation and de-escalation clause, and the third is the cost plus contract. So all of you watch it, like it, subscribe and share with friends. Thank you very much.